Welcome back to Your Money This Week. It's Friday, May 22nd. Andrew and I are back together. Stocks had a good week. The S&P 500 is up about a 0.5% since last Friday. Small caps measured by the Russell 2000 gained roughly 1.7%. Emerging markets were up about 1.5, and developed international actually led up around 2.4. Bond yields, meanwhile, have stayed elevated. The 10-year is off its recent peak. I think midweek was about 4.69%, but it's still sitting near 454 as we record this Friday morning. It's helpful to look at the bigger picture when you can. So, Andrew, we got a big time graphic alert here for you.
Ooh.
And yeah, I know you get excited about stuff like that. So, on the screen here, you can see where these major indices sit um, relative to the October 22 trough, basically. So, the market peaked in January how of 2022, how have stocks done and the different indices done since then. You see the S&P is up about 108% since October of 22. Small caps up, but lagging the S&P up 69. Developed international at 86, and the emerging markets pretty close to the S&P, 93%. Only the S&P is at its all-time high. The others have made all-time highs, but they've pulled back a little bit. So I don't know. Sometimes I feel like it's helpful to look at the bigger picture, not just week to week. And when you step back, how have stocks done during this recovery and where do they sit relative to their prior peaks? I just wanted to share that with our listeners. So today, we're going to talk about stocks. Obviously, we've already started. What Andrew learned from Home Depot's earnings call, whether rising rates should make you nervous, and what the new Fed Chair Kevin Warsh's preferred inflation metric means. But before we do that, please like the video, subscribe to the channel, check out my friend Andrew Hall at the Morning Market Briefing, his daily podcast. Check me out at the bostonadvisor.com. And I just feel like with these videos, we're on the verge of going big time. It's just it's a vibe that I get. I think last week's Divorced Dad Rock segment.
That stole the show, man. Like nobody, I got no feedback on any other topic, but a lot of people into the divorced dad rock.
Yeah. And I mean, some snide comments about, me liking Nickelback, but just a lot of, hey, that was probably your best segment, which is a little concerning since it had nothing to do with money. But you want to be an early adopter. You kind of like you knew us when type of person, not becoming our millionth subscriber. So, get on the train now.
Yeah. This is like seeing Nickelback at a very small nightclub in the mid 90s.
Right. Let's keep going with the Nickelback theme up in Canada. So let's start with Home Depot. You flagged their earnings as something to watch this week. Can you remind us why and then walk us through
Yeah.
the report?
Yeah, great setup. So Home Depot, last week we talked a lot about inflation. We also talked about the economy largely and where we actually were sitting, how things were looking. And I mentioned on the inflation picture that there was such a disparate view of how the housing market was actually performing. And we talked at length about that. I won't recap it, but the CPI figure on housing is insane. Home Depot is heavily levered to the housing market. They need the rate environment to be favorable. They need people moving. A lot of times, people, maybe if you've never purchased a home, you think, well, Home Depot is not where I buy a home. But when you buy a home, you're going to go to Home Depot 3 times a week for 3 months. It's just going to happen. There's going to be something you want to fix up. You're going to say, hey, we're going to wait till later. And your special someone's going to say, no, we're doing that now. And you're going to go and you're going to buy stuff and you're going to try to do it yourself and then you're going to hire a professional to do it, and he's going to go to Home Depot. So you might go to Home Depot 12 times, but somebody will go to Home Depot 24 times on your behalf when you buy a home. It's very levered to the housing market. So Home Depot on December 9th, so 2 quarters ago, December 9th, offered preliminary guidance for the year 2026. And what was interesting is they offered two sets. One was their baseline outlook, in which they talked about what they expected to happen in 2026. But they also offered what they called, notably, the official language. This is straight from Home Depot. They called it air quotes, a market recovery case.
Hmm.
Now, for a market to recover, it has to be in a place that is in a downward cycle. You do not call expansion. Expansion is not the same as recovery. Recovery is expansion off of a low. So they offered a market recovery case. And as you would imagine, if they think there is a chance that the housing market does better, that would be good for Home Depot stock. And you really saw that in the two sets of guidance that they offered again 2 quarters ago. So they said that in their base case scenario, they expected for comparable sales growth to be somewhere between 0 and 2%. So, on a like by like basis, hey, we think we could get growth of nothing or up to 2%. In the recovery case, where the housing picks up, they thought it would be somewhere in the 4 to 5% range. They expected total sales growth in the base case to be 2.5 to 4.5%, but they said, hey, it could be 5 to 6% if the market actually recovers. As you would imagine, with many businesses, Home Depot is not unique in this space. When they get increased sales, they also have more leverageability on margin. And so the profitability actually grows at a rate faster than the sales growth. And they said, hey, there's a potential that could happen. Ultimately, we are now 2 quarters later, and we are sitting in a spot in which we have received all kinds of economic data, some good, some bad, some questionable, some unknown. But Home Depot is saying very, very clearly that the base case is the case. The base case is the case. We are not seeing recovery. When you look at what they said in terms of their forward guidance, really for the next 2 quarters at this point, they laid it out for a full year. We're 2 quarters in, since they reported that. They basically said, hey, our base case was 0 to 2% comparable sales growth. We still think we'll hit 0 to 2% comparable sales growth. Noticeably absent from guidance was anything about the market recovery scenario of getting 4 to 5%. They think total sales are going to be up 2.5 to 4.5%. Long gone is any mention of the 6% figure. They did get a little bit of operating margin expansion, which is kind of interesting, but they're barely above the base case guidance that they offered there. And they said, hey, at the end of the day, what do investors care about? They care about earnings per share. The base case was 0 to 4% growth there, and they're saying it's 0 to 4% growth. Previously, they had said mid to high single digits would be the recovery case. So we have a major retailer that is very tightly tied to the housing market recovery that even went so far as to say we might get one, and to recognize that we've been in a pullback even 6 months ago, even in 2025. And now halfway into this year, they're sitting here saying, hey, we're not getting that recovery.
That's, really interesting because it's a practical read on the economy. It's not a survey, but it's what people are actually doing with their money and their houses. So what does that tell you now that you've kind of laid it out for us?
I think it tells you a couple things. Number one, as you alluded to this, Sammy, I think you said you had it on your Wednesday reading list last week. It's relatively impressive that the economy is in the position that it's in,
With housing doing so bad,
despite poor housing. It gives you, I think, a potential catalyst. I wouldn't say this is a reason to be bullish on the economy, but you know that bullet hasn't been fired yet, so to speak. And so where there is strength, areas like data centers, AI, whatever it may be, where there is strength, that's there. But the core, the American economy, it's a housing economy. It just is. That so much flows from that. For it to know that it is still at a very recessed level, you can view it one of two ways. You can view it as, man, housing sucks, and it does right now. Or you can view it as the economy is doing pretty well, even though housing sucks. When housing gets going, watch out.
Yeah, and we're both positive. We're both optimistic about markets, so I'm pretty sure we're going to read it the same way and look at the latter scenario. I do want to just get out ahead of something. You mentioned going to Home Depot when you buy a house, going 12, 24 times. To be clear, I will not be that guy. I am not going to Home Depot ever. I'm the guy who, if somebody's lending me a hammer or a screwdriver or any kind of tool you use at your house, they're ringing the doorbell, asking for Janine, handing it to her with specific instructions, and almost as if I'm not even there. It's like when Janine complains to me when she goes to buy a car, how condescending the car salespeople can be sometimes to her. That is me with tools, with Home Depot, with Lowe's, with anything. So I'm going to take your word for it, but I'm not that guy.
I'm maybe 1 degree higher than you. I caught myself in a truly unintentional, some would say lie, but I would say misrepresentation, in which I was describing to someone how I replaced the garage door opener.
Oh, wow.
pretty quickly in there, I realized they thought I meant like the motor, and I meant like the keypad.
Yeah, but
But I
even the
did do
keypad,
that.
I'd have to call like three friends
It
and
only
put a
took me a
committee
whole
together. Yeah,
Saturday.
yeah, yeah. My friend Kevin would get the call. I'd be like, hey, what are we doing here? How do I do this? So, all right. So housing could be impacted by rising rates, right? Mortgage rates are elevated, and it's a little bit of a different story depending on where you are in the country, which I guess sets us up to talk about rising rates because there's been a lot written and said about it lately. I continue to get questions about why the market is doing so well given the conflict with Iran, higher inflation, rising rates around the world, and our fiscal situation. Actually, believe it or not, continues to make its way into discussions. We've already talked about why stocks do well most of the time. So today, I'd rather zoom in on interest rates and bonds. And I guess I'll tee it up this way. Deficits in our fiscal picture have caused people to be pessimistic about stocks for way too long, almost as long as I've been alive. People have been worried about the deficit, starting with Reagan's tax increase in the early to mid 80s. And you can absolutely paint a scary long term picture, right? Large deficits, no political will or ability to fix them or reform entitlements. More bonds are going to be needed to be issued to fund this debt, which should probably put more upward pressure on rates. If central banks unwind their balance sheets, that could add more pressure. And at some point, the story goes the bill comes due. The problem is, which I laid out at the beginning, worrying about that has been a very reliable way to not make money in stocks. You've missed a ton of returns while you've been worrying about this stuff. And there are people who have definitely done that. So they're long term risks, but the market doesn't tell you when exactly they're going to show up in investor outcomes. But what's different now is, and why people I think are asking again, is this: we do have an inflationary war layered on top of what is so far still a good economy, despite the housing, as you mentioned. Shipping through the strait has been disrupted. Oil futures are still around $90 a barrel, pretty far out the curve. And that's going to feed through into higher prices for gas, jet fuel, plastics, fertilizers, and more things that we use and need in our economy. At the same time, rate hikes are now expected before we see cuts, right? The market has pivoted to expecting hikes before cuts. I think in December is when it's first pricing in its hike. And we're seeing something close to a coordinated move in higher yields globally: US, UK, Japan, all higher yields. So the question is, I know it's a very long preamble to the question. Hopefully you're still with me. Is this finally the catalyst? Is this the tipping point where those long-term fiscal and rate worries start to really matter for investors, or are they still just largely separate stories and one's got nothing to do with the other?
I think it's going to remain separate. I don't disagree with either set of concerns. I really don't. What's interesting to me as we think about the rate environment right now, and I think you did a great job of teeing this up. We're seeing rates move. I mean, everywhere. Some of the sovereign debt that it felt like. I mean, we used to joke about literally negative interest rates. There's places now where it's like, no, you can actually make pretty good money. And what's interesting about that is uh, there is, I think people often, I mentioned this on our morning market briefing a couple of days ago. I think people often on fixed income, they miss the supply and demand dynamics that
Hmm.
exist. I really think they do. It is much more of a classic market lowercase m, not stock market. It's much more of a classic market where whatever you're selling is worth what people will pay you for it. And I contrast that with, yes, that's true on stocks, but at the end of the day, I could get off this call right now and go buy Apple stock. That's not a recommendation. It's an example. I can go buy Apple stock and you can get off the call and go buy Apple stock. And I don't actually need you to sell me the Apple stock. Somebody else will. There's so many people out there constantly trading. And the reality is on fixed income, you need a specific buyer. You see that in the bond auctions, and you also see that in the rate environment. And what worries me about the cycle we're in is everyone else has come up on their rates and yields have risen. The demand for the U.S. has shifted a little bit, and so I don't know what's going to cause that to calm down, because the reality is the way we get the longer end of the curve down is we get a whole lot more demand for this.
Hmm.
And part of getting the demand into those 10-year, 20-year, 30-year treasuries, corporates, whatever it may be, part of the way you get demand there is they look more attractive than anywhere else. And that's not the case right now. And that's not a criticism of the credit worthiness of the US. Rather, it's just a statement of facts where you can get paid more elsewhere. And so I think that's the dynamic that I'm most intrigued by. You mentioned rate expectations. I continue to caution against buying into rate cuts and rate hikes and what's expected. If you go back to middle of last year, people expected 7 rate cuts in 2026. And now we're talking
Yeah,
about a
I,
rate
I
hike.
remember you guys talking
Um,
about that, and also I remember those expectations. Yeah.
and so I would caution against that. And I think that um, what's interesting, I'm wondering for a long time, it's always been a popular narrative that the smart money is in bonds. The smartest traders are bond traders. Right now, the bond traders seem quite reactionary. Hey, this is really attractive. Let's eat up that part of the curve. This is really attractive. Let's eat up that part. And that's not a criticism of them, but we're getting a fast paced game of whack a mole with really attractive opportunities all over the board. And I don't know what the Fed is going to do or should be doing in this situation, because I think I probably said this on the first one of these calls that we did, Sammy. I continue to remain more concerned about the employment picture than I do the inflation picture.
Yeah.
I continue to be more concerned there. And you've got two different narratives going where, hey, we're worried about inflation. Maybe we should raise rates. Hey, we're seeing more and more layoffs even this week. Maybe we should cut rates. And I'm curious if and when those two flop in terms of priority. It seems like we have a dual mandate, but right now everybody's focused on one.
So you said you see them as kind of separate stories, separate incidents, which I tend to agree with. But then you did layer on a very real concern about the demand issue.
Mm-hmm.
So, that I guess now that makes me a little bit more concerned. I've always felt that I'd really start worrying intellectually about this deficit story when rates started rising in a meaningful way. And they are creeping up. And while I do think it's primarily the war, you can never say for sure why a market move is happening. So for me, I think there's just still going to be a little bit of a nagging concern watching rates and hoping they don't keep kind of creeping up and to the right. But if you're right,
I
primarily
would
in
just
that,
say I would
yeah,
add there real quick on the big chart idea. I don't have the chart. I don't know how to screen share from my laptop to my phone, but
I'll do
I,
a tutorial with you between now and next
yeah,
Friday.
yeah, you
Yeah.
can teach me.
All right.
I would continue to. This is an area in which I actually would look at history.
Mm.
Even as we sit here and talk about a 4.5, a 4.6 on the 10 year, it's elevated compared to where we've been. Certainly coming out of the global financial crisis, it's elevated compared to where we were at the beginning of the year. It's elevated compared to where we were about a year ago. If you looked at this whole chart, you wouldn't say, man, that's a really high level.
No, you wouldn't. And also the velocity hasn't been an issue, right? In
Yeah.
2022, while I pointed out how stocks did after that bear market in 22, which was driven by a very fast increase in rates, the velocity has not been there. So you're right. These levels in and of themselves, I wouldn't say are high. And if you're right not to be too concerned with the long-term picture yet, even though you did raise a couple of concerns and you do see the issue, bonds are getting cheap and I would
Yep.
say more attractive. So,
Yes.
to put it this way, if our investment committee came to me and said, we're adding duration here to take advantage of these higher yields, I would understand it, but I would be a bit concerned because I don't want to take too much risk with my fixed income portion of my portfolio. And I do think interest rate risk is real. So it's something to keep watching, I guess.
I think interest rate risk is real. I also think on an individualized portfolio, I think it's where like what you're doing with the blog in client meetings, even this, I think it's really, on a professional note, it's where the education piece is so vital
Yep.
and helping clients actually understand what taking on more duration risk means. Most client would say, oh, I can get making up a scenario, but I can get 5.5% every year for the next 20 years. Give me that bond. And if you held it for 20 years, that would be the reality of the picture. What they don't recognize necessarily, if we don't educate them, is that, hey, you might be down a little bit next year.
Yeah.
You might be up a little bit more. You might be in a spot where we actually want to sell it because, rates have sold off and now all of a sudden we can get 4 years worth of income by selling this.
Yeah.
But that's where that education piece comes in.
Yeah, you're right. I mean, besides us shopping for clothes at the same store, apparently, I think we see things very similarly. And I think, you know, where does this filter in? I always wonder about this when I'm digging into topics either on the blog or with you or other venues. What's the takeaway for people? And I think the takeaway is that educational point that there is some risk with where bond yields are, but they are attractive. So just be patient with your positioning. It doesn't necessarily need to work out every week, every month, or every quarter. But watch it because it's interesting. I think if you expect mortgage rates to back down anytime soon, I guess I would bet the opposite. I feel like mortgage rates and the housing market are not going to be improved by this conflict
Yeah.
that we have going on, right?
Yep.
And the inflationary pressures it's generating. And I don't know, we've talked before about economic cycles and how we haven't had a normal economic cycle in a while, right? We had COVID, then we had those, 2022 rate hike bank failure quick cycle. We had, um, so not clear cut. Economy gets too hot, Fed raises, slows it down. We get a recession, rinse and repeat. But if inflation and rising rates does cause an economic contraction, a recession, I would just say, as a business owner, to some of my small business owner clients, um, just be aware of that as you're thinking through your options for your business. If you're somebody who wanted to exit in the next year or two, you probably want to keep moving on that if the environment is still good in your industry,
Yep.
because if things slow down, now you're maybe in a position where you're not getting the exit that you want, or you're waiting through the recession for numbers to get better. And that's not a
Yep.
prediction of a recession. That is more, can you afford to be wrong on the timing?
And I think you're exactly right. And I think oftentimes, especially on kind of these small to mid-sized businesses, people get so enthralled by valuations.
Right.
I got paid this multiple. You can lose sight on, well, it's a multiple of something, either revenue, profit, whatever the figure is, depending on your industry. Don't lose sight of what that something might be, even if the multiple does creep up.
Yeah,
You don't want
exactly.
to be in a spot in which you say, oh, the multiple went from 10 to 14, but profit got cut in half.
Right. And now you have to wait it out to get your numbers back, or you're not having the exit that you planned for. So that is something I have been talking to a few business owner clients about. So then last week we talked about the 2% inflation target, and you raised this as a question about, I mean, basically to paraphrase, like, hey, what's the big deal with two versus three? Why did we need to be two? Couldn't being in this range roughly be okay? Do we think they're going to change it, declare victory, whatever? So this week I wanted to follow up with you. That's something that came out in my Wednesday reading list this week. Kevin Warsh's preferred inflation measure. The metric he likes is called Trimmed Mean PCE. And as far as I can understand that, you're not excluding entire categories like food and energy the way some core measurements do. Instead, you're removing, I guess, the most extreme movers each
Yep.
month, both
Yep.
the biggest winner and the biggest loser, and you focus on kind of the meat of the curve, the middle broad part of the distribution, where most prices are going to live, and you ignore that outliers. And so, did I explain that correctly?
Yeah, I think they
Yeah.
take out those extreme ends to kind of say, well, what's the actual core? And the core might be different next month.
Correct. Yeah. So trimmed mean PCE is running at 2.3, 2.4%. In other words, on this measure, inflation's not perfectly at the 2% target, but it's a lot closer to 2 than looking at the other measurements. So you could say that they're going to adopt this, or maybe they do adopt this and they get closer to their 2. They can declare victory. They have cover for cutting rates. And to your point, you're more concerned about the labor market than inflation. Do you find this trimmed PCE intellectually satisfying, or do you feel like it's a way to provide cover for cutting rates without getting to the preferred target on the preferred metric they've been using up until now?
Candidly, Sammy, I don't know. I don't love it. I'll say that.
Yeah.
It seems like you open yourself up to, it seems like at periods of time, this might be the most accurate read of inflation at periods of time. Imagine a scenario in which, I'm just making this up, but, used car prices are through the roof and simultaneously gas is unbelievably cheap. Well, for most people, one thing being extremely high and one being extremely low probably doesn't change their day-to-day spending all that much. Gas is actually a relatively small portion of the everyday budget. So that being low isn't giving you that much relief, and used cars being extremely high doesn't give you that much of a benefit. So, okay, in that case, making that hypothetical up, okay, maybe this core bundle is accurate. My concern with it would be what happens when shelter's through the roof.
Right.
The opposite scenario of here is that how much of that's getting trimmed out. What happens when energy at large, utility bills are through the roof or plummeting? I think it opens itself up to having things that are.
There's just more volatility, you're saying, maybe in the number and the measurement.
I actually think it almost exacerbates volatility, because not only are you stripping something out every month, but you're also stripping out potentially different things. And so I don't know that it's academically dishonest. I think it's clear in what it is doing. But I also don't know that he's cherry picking this. I don't know enough to know if he's cherry picking this to justify a
correct.
Rate cut.
I added a whole lot of supposed motivations to the conversation. Yes.
Yeah. So I don't know either. I will tell you that I don't love it. And frankly, part of it is I feel like there's enough good economic data out there in which you can have a real figure that's not adjusting its components every month.
Yeah. Yeah. No,
even if those adjustments are by rule and you would say, oh, they are formulaic, I think you can do better.
All right. Well, I agree with you, and I just thought the timing of finding that article was interesting given the topic that you raised last week. So I'm going to get us out on this. A few people, I mean, now that again we're on the verge of really breaking through with this weekly conversation, have asked, how did you and Andrew get together? So we've been talking about superheroes this week a little bit randomly. So what's the origin story of Sammy and Andrew is basically what people are asking.
Yeah. So Sammy and I did, Charles Schwab had an executive leadership program. We did it in 2019.
We did.
A lot of the older people in the group never remember what year it was, but it was 2019.
Wait a minute. I'm the oldest person in the
group. So we did it in 2019, and there was a kickoff event, and I don't even know that you and I met or interfaced or interacted during the kickoff event or the entirety of the year-long program. I don't think we were ever in the same group, anything. And then there was a capstone event at the end in Austin, right?
In Austin,
in Austin. We had dinner at the hotel, and then I think I was maybe talking to our mutual friend and longtime study group partner, Chris, at the bar, and he was like, you want to have dinner with us? And you were one of the us. And I was like, yeah, sure. And little did I know that a study group had been formed by people who had already studied together and knew each other. And I just sat down at the table and had dinner. And that's how me and Sammy met. And Sammy ordered a cocktail with a very flowery umbrella.
No, that is not true. I don't think that's true. Yeah, I think that's
definitely true.
That's heinous for you to say that. There might have been a hurricane, but anyway, yeah, which I had never had before.
You definitely had an umbrella on that drink.
I'm gonna have to go back and ask other people there. So yeah, we've been in this study group. I don't know why we call it a study group. We basically get together, as industry peers, compare notes, help each other out through personal stuff. There's 8 of us. Usually the 8 people who listen to the episode every week are those folks. We become great friends, and you and I have kind of collaborated on different things. My son interned for you a couple summers ago. He interned for me first. I think we did a great job of convincing him to go into real estate instead of wealth management collaboratively. And we just love talking about this stuff, so we figured we'd record it while we're doing it anyway.
Yeah, it's fun. I love doing it. And yeah, I mean, Sammy, this year I'll hype you up. You're a great friend. I lean on you for a lot. I mean, even this week we were talking about something work related, and really value your counsel. And it's fun. I'm very thankful in life to have people that I don't see every day, but I can talk about what I'm doing every day with.
Yeah.
And I can talk about totally non-professional stuff with. It's a pretty unique situation to have that with someone that lives in another part of the country.
Yeah.
And that's part of what makes this fun.
It's been extremely valuable. It's a group of friends who know exactly what you're going through personally and professionally because they have the same roles, the same interests. And if it's any indication as to how seriously we take ourselves, our group name is IOMT. And you can figure out what that means, listener, on your own time. But IOMT, the Island of Misfit Toys, that's our group. So that's to answer all the questions about how come we're doing this together. Have a great Memorial Day weekend. Any big plans?
Not a lot. It's my daughter's last day of fifth grade today, so I've got to leave here at lunchtime and go play in the parent kid kickball game.
Oh,
So
wow.
that's I would
How's your
appreciate
back
if
though? Are you
I
gonna
was
be
gonna
able to
say
pull that off?
if you're a person of faith or even just good vibes, send some prayers and good vibes my way that I don't get injured playing kickball against a bunch of 10-year-olds.
Yeah, you've had some big back problems. Although we have a small step challenge in our group, and I feel like all you've done is walk since we started that thing. You're running away with it.
I walk a lot. I've gotten to where because I can't run and I can't lift anything over 25 pounds, I've gotten to where if I have a phone call, I'm walking while I do it.
Yeah. All right, slow down because I need to come back on this thing. I'm now in fourth out of fifth place. Have a great weekend, buddy. Thanks
All
for
right.
your
See you,
help.
man.
See ya.